Good evening. Tonight is Tuesday, January 15th, and we're in Business 2505, Section D, winter 23rd. So I see a little bit more people in attendance. I'm guessing some people had an extended Christmas holiday or something. Welcome back. So tonight, last week we did review of Chapter 2. This is a chapter that's covered in 2504, but I just reviewed mostly the concept of cash flow and capital cost allowance because it's used throughout this course. So it's going to show up a little bit again tonight, but mostly we're getting into Chapter 10 now. In 2504, you did Chapter 9, which was, what's net present value, what's internal rate of return, that kind of, the very basic things. Now what we're getting into is a little bit more realistic. So the stories are, you got a whole story you got to come up with, pull the numbers out, and basically just like a financial analyst would do at a corporation. Sorry for the delay. It's better now. I was the slides hadn't synced to my laptop. So quiz 1 next Tuesday. I saw there was a problem when I saw September. So this quiz 1, Tuesday, January 22nd, the first 20 minutes of class. So, if you get here 5-10 minutes early, that's half of your time gone. So no bonus time given for, there was a lot of traffic, no bonus time given for I missed my bus, that kind of stuff. It's your responsibility to be here at 6:05. And if you're not, then you're missing out on that time. The material is chapters 2, and so what I covered last week, and 10.1 to 10.6, which is what I'm doing tonight. It's going to be 10 multiple choice questions, a mix of qualitative, meaning text stuff, and quantitative, meaning number problems. You're allowed a formula sheet. There are no rules at all. Like, can I do this? Is it printed? Is it handwritten? Single-sided, double-sided, what am I allowed to put on there? You're allowed to put whatever you want. I should have said double-sided because I'm not going to go through and check that, you didn't put, if I say single-sided, that, I'm not going to go check every back page. It's going to be, for the quizzes, it's going to be overkill because, 2 pages essentially of formulas for a single quiz is way more than you need. But this is going to be the same setup also for the midterm and for the final. So for the midterm, it's going to be one double-sided formula sheet. You put whatever you want on there. And same thing for the final exam and all the quizzes. I started using CU Learn instead. How many people have actually used CU Learn before in another course? So, okay, I don't have to, teach you too much about it. It's pretty obvious. In there, I post the slides and the notes. Slides being what I'm going through right now. Notes is the what I'm going to be writing on the board. So I actually had this over the summer, the TA type all my handwriting from all my everything that I write through the term. So if you miss a course or after you're reviewing, you have it here. And also, while I'm teaching, you don't have to spend all your time and energy just copying down what I write on the board because it is available on my website and on CU Learn. The other thing that I've put on CU Learn, which is extremely important, are the suggested exercises. Students always ask for lots of those. You have lots and lots there. They're from the questions at the end of each chapter in the textbook. You can use 6th and 7th. We actually did the full worked out solutions for both. Now, for 2 reasons. 1, copyright, and 2, if there's another prof somewhere that's using those as a homework assignment, then I can't put those on the open internet, so I can't put that on my lemma.ca website. But they are on the CU Learn. At the very top, there's a a folder called quizzes/midterm/final. And in that folder, well, right now there are the suggested exercises. So first it gives all the question numbers, then it gives the fully worked out solutions for 6th and 7th. And that's available only on CU Learn, because of these 2 reasons. If you don't have a textbook, I'd put mine at the library. And like I said, you can use 6 or 7. It really doesn't matter. In the suggested exercises, they're available both. The textbook is available at the library in case you just want to go and look at the, on the odd chance that you don't have a textbook, or sometimes, the bookstore doesn't order enough or something like that. Videos are available, well, not quite yet, on YouTube. So I just have to get a hold of the TA this week, and he's gonna do the video for last week and this week. But at the same time, on the YouTube channel that I have, you can just go and see the same class from when I taught in the fall, and there's barely any changes. Every time I teach, I try to improve here and there and polish it a little bit. But if you want to get started, at least if you want to study on, say, on Wednesday or Thursday, and the videos are not up yet, I'm expecting we'll do the videos either Saturday or Sunday. That's either Friday or Saturday. That's usually when the TA is available. So, any questions at all about quiz or anything else? Okay. So tonight I'm going to do a big part of Chapter 10. In the past, I've tried to do Chapter 10 in a single lecture, but at 10.7 is quite difficult. There's some pretty technical and some pretty difficult problems there. So I knew that I was not able to do 10 in one night. So instead what I did is I tried to split 10 in 2 nights, but really tonight's going to be 10.1 to 10.6, which is going to be the material that's on the quiz next week. And then next week for the 2/3 of the class that's available, I'm going to do 10.7. And then that's going to give me more time to do these problems in a little bit slower, a little more detail, and a couple of variations so that you do a little bit better. Because I put on the final exam that just happened for the fall, I put a question from 10.7 in there. People had a really hard time. So obviously I need to improve on that part of the course. So trying to do it all in one night was way too crunch. So I'm going to do 10.1 to 10.6. I'm going to do 10.7 next week. Remember I told you at the first class, yeah?
I just have a question for the suggested problems. Does it separate 10.7?
No, but you can just see it from, it's obvious what's material that's 10.7 and that's not. Just so for 10.7, the 2 things are equivalent annual cost and bid price. So if you see any suggested exercises that are equivalent annual cost or bid price, obviously don't worry about those. Those are going to be covered next week. But if you see any topics in the slides that also have a suggested exercise, then obviously you should be able to do it. And this is not so much a read like hundreds of pages and memorize text and then write an exam. It's mostly a practice course. It's about getting you ready for 3rd and 4th year. Getting used to formulas and solving problems, that kind of stuff. Let's continue with this. Cash flow, like I told you in the first course, you're going to hear that expression in this course over and over and over again until you're pretty much sick of it. But that's what we're studying. In this case here, we want to look at the idea of relevant cash flow. So what we're going to do in Chapter 10 and a little bit in 11, and obviously if you go out in the world and get a job as a financial analyst, that's the kind of things that you do, is you're given a story and there's usually a decision. So it could be, I'm going to open a restaurant and I'm going to make that much in sales, or I'm going to open a retail store. I'm going to need that much inventory, or I have a manufacturing company and I'm going to buy a piece of equipment, or I'm going to open a new factory, that kind of stuff. You're given a story and you have to do what's called financial analysis. You have to look at, from the text, what are the cash flows that are happening. And when we come up to getting into a decision, we want to look at only the cash flows that are relevant, what we call incremental cash flows. Cash flows that are going to happen only if we do that project or not. So here's an example. If I'm going to decide if I'm going to open a new location and I have to build a building, well, if I do the project, I'm going to have to build that building. If I don't, then I don't have to build that building. So it's an incremental cash flow. You got to look at, going back to that very first question, will that cash flow happen if the project goes on? Yes or no? If I'll get into that next line a bit. The last part that they're talking about, standalone principle, here's the idea. If you're already a company of a certain size and something's going, you have many things going on, and you want to look at, am I going to do something new, yes or no? Then what you do is you look at that project or that decision as if it was a single company, as if, in isolation, like there's nothing else from the rest of the company going on. So you look at, if that project was a company by itself, would we start that company? That's the same for a big company to say, are we going to do that project, yes or no? So we look at it on a standalone. We only look at it by itself. So how do you think about, or how do you decide a relevant cash flow? Will this cash flow occur or not occur only if we accept the project? If the answer is yes, it should be included in the analysis. If the answer is no, it should not. Here's an example. We won't do it in this chapter, but one we're going to do later. When we get into lease or buy, that's another type of decision, but just to illustrate this idea of relevant cash flow. I have two decisions to make. Well, one decision. Am I buying car or leasing cars for my salespeople to go out and sell, bicycles? Well, for this decision, am I leasing or buying cars, the amount of money that the salespeople are going to make while they're using those cars is irrelevant, because whether you lease the cars or you buy the cars, they're still going to go and sell and make money. So that is an irrelevant cash flow to that type of decision. Sometimes you'll have something like, the answer is part of it. So it could be, I have a mall, I have a parking lot, and I'm going to use just some of that parking lot to build a new, retail store. Well, if we look at the cost of the whole parking lot, when we look at that decision, we would only look at the incremental, the part of the parking lot that we would lose if we build that building on it or not. We wouldn't care about what the rest of it is. So when the answer is part of it, you would split that, the cost for the parking lot, into the part that is incremental, yes or no, and the part that's going to be there whether you build that new building or not. Here's an example. KN Jewelers purchased some land 4 years ago at a cost of $218,000. They spent $45,000 to raise, meaning demolish the old building and clear the lot. Today the lot is valued at $237,000. KN wants to build a new retail store. To prepare the lot will cost $28,000. The building will cost $229,500. What is the cost of this project? Well, first of all, whatever you bought the piece of land 4 years ago, who cares? What you really care about is today, there's two things I could do. Yes, I could build a new retail store, or it says there that I could sell it for $237,000. So even though I'm carrying the land on my books at 218, when it comes to the decision of do I build a new retail store or not, you would use the market value today. So in that case, it's 237. So when you look at the relevant cash flows here, you have the 237, which is what I need to. My alternative is to just sell the lot. So that's a right amount to use as what am I going to use for the cost of that lot. Because if I don't build the store, I can just sell it for 237. So in buying the store, I use that as my cost for the land. The second, the lot preparation cost will be $28,000. Is that cash flow incremental? Who says yes? Most of you are wrong. It is incremental because if you build a retail store, you're going to have to prepare the lot. If you don't build the retail store and say you just sell the lot to somebody else, you're not going to end up having to pay that $28,000. So that $28,000 is an incremental cost to the project. Buy a new, not buy, but build a new retail store. And obviously the building will cost $229,500. Obviously if I decide to build a building, that is going to be incremental. You're saying yes? Obviously. Or do you have a question?
I've got a question.
Yeah.
In accounting, we took that if you raise, right, a building or whatnot, then we take into consideration the cost of that. What about the 45,000?
The 45,000. No, because it's already done. Did you learn in accounting about sunk cost? Yeah, the 45,000 is a sunk cost because it says they spent in the past 45,000. Right. Sometimes you got to be really careful in reading, the sentences and the verbs and the different tenses. But that 45 is gone. Whether you build that thing or not, it really makes no difference. Yeah.
I think that's just like the 45,000. They weren't intending already at that point to build the new store, so you can't include it in the cost of the store. Because they did that 4 years ago.
Yeah.
They knew that they were going to build the store at that point.
Possibly, if they hadn't done that, if they hadn't cleared the lot to get ready for somebody else to do something with it, then they might not be able to sell it at 237, right? If they didn't spend the 45, then maybe the lot would only be worth 200. You'd only be able to sell it for 200 because somebody buying it would have to first clear off the whole building. But everything goes into what is the market price of the asset that you're going to use in your project today. It really doesn't matter. Sometimes you might have spent more. In that case, it looks like they did spend more. 218, 250, 263. So on the balance sheet, it's carried at the cost of that asset is carried at 263, but its market value is only 237. So just remember, in finance, what's important is market value or fair market value. Whatever is written on your balance sheet, there's lots of reasons why it might be different than what's going on right now. So just to finish at the end, obviously if you decide to go ahead with building a new retail store, you're going to build a building, and if you don't, you're not. So that's another incremental cash flow. Yep.
So the 237 is just being used project, whether you do or not. You're not going to put it in your books after. Let's say you accept the project, you're not going to put 237. It's an opportunity cost, right? You're not going to, because then you'd be doubling your cost of the.
What you would, depending on how you would account for this, if you're setting this up as a, I'm not going to get too technical with the accounting. This has to do with accounting for combinations, that kind of thing. It depends whether you have a different different company for the other one or not. But then you need to adjust between fair market value and at some point. But here's the idea. From the point of view of finance, the decision is, if my company didn't already have that land, I would have to go out and buy it for, what somebody's selling that land today. Not what they paid for 4 years ago or what they paid to fix it. Whatever, if I didn't own that lot already, I would have to go and buy it. If I already own that lot, my alternative, if I don't build that store, I can just sell it for that 237. So that's the proper cost to use when you look from the point of view of project cash flows. So those are the types of cash flows that we looked at. Sunk cost, should know that from accounting. This is a cost that's incurred in the past. So it's irrelevant to the decision you're going to take in the future. If you have a sunk cost and then you do some financial analysis to decide whether you're going to do some capital investment or not, it really doesn't matter because that money has already been spent. It's not money that's going to get spent or not based on whether you decide or not to go ahead. The next one, opportunity cost. It's weird to hear your own voice in this weird echo. Side effects. You can have positive side effects and negative side effects. I'm not going to talk about them too much right now, especially the positive side effect. Those are typically called synergies. I'm going to talk a lot more about that in mergers and acquisitions. But these are things that happen that are good to other projects. So an example would be say I'm going to build a new factory. And so that factory is going to need some, let's say, copper. But I'm already using copper other places in my business. And so by having this new project, now I'll be buying more copper. I'll have more purchasing power, to negotiate with suppliers, and that might reduce my cost of that, input material. That's an example of a benefit to another project. It could be that if I have, plants all over the country, or say I have offices all over the country, but I'm gonna simplify into 3 offices, then all of a sudden things are closer together, so there's less travel costs or less long distance. Those are examples of positive side effect. Negative side effects. There's an example coming up, which is erosion, and in the textbook it's called erosion. In the world. Out there in the real world, you'll hear more the expression cannibalize, right? When Apple introduces an iPhone 5, then all of a sudden people are not buying iPhone 4s anymore. So that's an example of when you look at a project, if you introduce a new product, then the sales of your own product in that line from before, they're going to go down. So that's an example of a negative side effect. There might be others, in special situations, but that's the one I could think of there. Other cash flows you got to look at. Changes in net working capital. Remember when we did cash flow from assets last week? when you look at the cash flow in a company from the internal point of view, if you need to increase your net working capital, that means your overall cash flow is going down. Here's an example. Going back to, even if I just look at this example, if a jewelry company is going to build a new retail store, they're going to need to put inventory in that store. And so you will have, remember that inventory gets cash and inventory and accounts receivable and accounts payable get captured inside that net working capital. So every time you open a new retail location, you need to put inventory in that location. That means that your net working capital is going up, so you need to finance that cash from somewhere. Another one that happens in changes in net working capital is if you're selling on credit, right? Instead of doing cash sales, where in this case, you sell a good or a service to a customer, you give them an invoice, they have 30 days to pay. What happens if you double your sales? Your accounts receivable go up, double. That money has to come from somewhere, right? You need to buy something, then you sell it to somebody, and then you only get the cash, 15 days later, 20 days later, 30 days later. If all of a sudden your sales double, your accounts receivable double. You got to finance that from somewhere. Financing costs, this will be interest on debt and dividends on stock. Inflation, what I could say there, even though I'm not going to do it in this course, is I've seen where people do business plans and they do an inflation adjusted type of cash flow forecast, but I won't really cover that in this course. The last one is a little bit technical, but it's actually quite important. If you buy something and then you get the capital cost allowance, that will reduce your tax payable. So the cash flow effects of buying a piece of equipment, there's two things that, well, there's really three, but let's talk about the two main ones. The first one is when you first buy it, you have a very large cash flow. Right, I buy a car for I got a taxi company. I buy a car for $50,000. But then for say the 3 years that I have that car, I get the CCA depreciation on it. That CCA deduction reduces my tax payable, so that increases my cash flow. That's something people have a hard time understanding because they think depreciation is something going down, so that's a cash outflow. But from the point of view of cash flow, having capital cost allowance through the life of the project increases your cash flow by the amount of the CCA deduction times the tax rate. You'll see an example of that later on. So first, an example of opportunity cost. Most valuable alternative that's given up if you take up an investment. So you purchased a warehouse for $335,000. Repairs were made for $60,000. The annual taxes are $20,000. The warehouse has a book value of $268 and market value of $295. The warehouse is paid for. If the company decides to use this warehouse in a project, what should you use as the cash flow? $295. It's the market value, similar to the one we did before. It's just specifically just the opportunity cost by itself, because you're not going to be able to sell it for $335, and the $60,000, that's a sunk cost. The annual taxes on the property are $20,000. Well, you're gonna pay those taxes whether you use that warehouse or not, because you can't go to City Hall and say, "Oh, I wasn't using that piece of property. Can I not pay my taxes, please?" They're gonna laugh at you. So the $20,000 happens whether you go ahead, you use the warehouse or not. The relevant cost here is the opportunity that you could sell it to somebody else for $295. Now let's do an example of erosion. So we have 3 product lines already. And now we're thinking about introducing a 4th product line. So we're selling trees, shrubbery, and flowers. So we think that before introducing that 4th product or 4th product line, well, we know those numbers. So we're selling $180,000 worth of trees, $286,000 worth at 400 worth of shrubbery, and $62,800 of flowers. Now, if we introduce that 4th product line, obviously in the retail environment, it's all about sales per square foot. So, can somebody tell me what is the most important metric when you look at retail? Revenue, cash flow, profit. No, one of the most important operational metric when you look at retail is sales per square foot. So and that's why something like the Apple retail is such a success story, is because they sell thousands and thousands per square foot that they got. If you go to a dollar store, they'll sell $20 per square foot that they have. Square footage in malls is extremely expensive. The closer you are to the best place, you're not on the 3rd floor off a branch or that nobody walks by. Retail space is extremely expensive. Normally retail stores, and I look at financial statements of lots of retail stores, after they pay their rent and after they pay their staff and the inventory, there's usually very little profit. So what this company is doing is they're trying to improve their sales by square foot, because they know that if they go from 3 products, they're say spread over 1,000 square feet. So each one has about 330 square feet of display space. If you're going to sell a 4th product, you're going to have to put it somewhere, and that means that you're going to have less square footage for your original 3 lines. At the same time, the people coming into the store only have so much money in their budget that they're going to spend. So both these effects are going to lower. Yes, you're going to get more sales from introducing that 4th product, but at the same time, introducing that 4th product is going to reduce the sales on your other 3. In this case, trees are going to go to 168. Shrubbery is going to go to 239. 700. And flowers is going to go to 59. 900. So you'll sell 21,000 less of trees. You'll sell 46,700 less of shrubbery, and 2,900 less of flowers. So you can see here that in the original 3 product lines, you're going to sell $70,000 less dollars, but you're going to be selling another $136,800 of flowering shrubs. So that's a decision that makes sense, right? You introduce a 4th line, and the incremental sales of that 4th line are bigger than the incremental loss in sales that you have on your original 3 lines. So that's a decision that makes sense. A little bit of review. Pro forma, I gotta say something about, this is gonna go back to the accounting guy from earlier. Something that's gonna be very confusing to some of you is that finance people and accounting people both use the expression pro forma, but they mean different things in the two different disciplines, the two different subjects. In accounting, pro forma means where you're stating a balance sheet or an income statement and it's not in compliance with GAAP. So, companies do that sometimes. They'll release their normal GAAP earnings, but then they'll have pro forma earnings where they're showing the business in a different kind of light. Sometimes they capitalize an expense or something like this. So pro forma in accounting means one thing. In finance, it means something completely different. It just means forward-looking information. So pro forma means simply just a forecast. It's when I say a pro forma income statement or a pro forma balance sheet, what I mean is if I do this project, what is the income statement gonna what is the income statement gonna look like? What is the balance sheet gonna look like? What is the statement of cash flow gonna look like? So that's the difference between pro forma and accounting and finance. Just a little bit of review from last week. Operating cash flow is the earnings before interest and taxes. You add back the depreciation because, like I told you, depreciation is it's not a cash flow. It's not money that's coming out of your pocket every month. It's just a creation. It's just something that comes from the imagination of accountants. It's not money. Yes, it's showing up on the income statement, but it's not cash that's actually moving. Minus taxes because you got to pay your taxes to the government, and that's an outflow. So operating cash flow is a form of after-tax cash flow. And the other one was, I just showed that to you before, cash flow from assets is the operating cash flow minus the net capital spending minus the change in net working capital. Remember that there's two minus signs there, even though, well, this time I won't be giving you a formula sheet, but even when I give students a formula sheet with the minus there, they go in the written problem, they do the question, they put pluses. I don't know why, but make sure you know it's minus the net capital spending and minus the changes in net working capital. So let's look at an example of a pro forma statement. So this is not something that's happened where you're doing the accounting statement for a company. That's something that's happened in the past. What you're doing is the income statement, what it would look like based on what your prediction is. So the sales and if you ever own a business or work for a business that's going for financing at a bank, you always do these things, right? This is it's one of the standard things that you put in a business plan, like, the marketing people put a SWOT analysis, while the finance people do a pro forma statement, a prediction of cash flows, typically over, 3 to 5 years. So the sales are 12,840 at $43 per unit. So that's going to be 5,120 less first the variable cost. Well, that's going to be the same amount of units. The variable cost is $21 per unit. I just spotted a small mistake in the notes. I'm going to explain to you why it's important. When I say less, I mean that's already a negative number. If I put that in positive, sorry, I said that last week, but I want to remind you so everybody gets it. If I say less and then I put a negative number there, what I mean is I'm adding something, right? It would become minus a negative number. So just when the TA typed them in the notes, he put brackets, but that shouldn't be there. You have depreciation. Now you're going to say depreciation is not a cash flow. Why am I putting it in there? Well, you need to put depreciation to get to your EBIT, to get to your taxable income, to calculate how much tax you need to pay, and that number is a cash flow. So that's why you got to consider depreciation anyway. In this case, it's straight line over 7 years. So it's going to be whatever the full cost. 1/7 of it is going to be depreciated every year. That's 124. And then you also have the fixed costs, and those are just given. So you get the EBIT, earnings before interest and taxes. That's 53. The reason why we do split, because if you have done first year accounting, you would have said, well, we just put all the expenses together, right? We just put, interest we put there. The other thing you've noticed is that I didn't split between direct costs and variable costs. I just piled everything into it. These pro forma finance statements are just a abbreviated way of doing the income statement as a forecast. You don't split into variable cost and then gross margin, blah, blah, blah. The reason why we split the interest is because we want a measure of profitability which is independent on how the company is financed. Some companies will have more debt. Some companies might be just all stock. That's going to change the interest payment. And so the reason why we split EBIT is to get a measure of profitability that doesn't include the financing costs, the interest payments and the dividends. It's independent. It's the amount of money that can be shared between the owners of the company. So then you take out interest expense. That gets you taxable income. So taxes are 35%. So that net income but what is the operating cash flow? The reason why we did that is, remember the formula for operating cash flow. That's one formula. I'm going to show you 3 more today. But the basic one, we need the EBIT, the depreciation, and the taxes. So I'm going to have to a bit short on space. So you can see there's a pretty big difference between the operating net income and the actual cash flow. Okay, it's 7:10. We're back. So I picked this example for this part of the chapter because it brings everything together, and it's typical of what you can see as a written question on a midterm or a final, where there's a lot of different information in there. So that's why I picked that. As you're not going to see written questions in the quizzes, because the course supervisor, she wants to do all multiple choice. So if you look at, you go and you talk to some of your friends and you see my quizzes from the past couple times I did this course, you'll see that even in the quiz I do some multiple choice and some written, but for this section in this course, this term, it's all multiple choice. But this shows you, it's a great example of all the different things that are happening in a project analysis cash flow kind of decision. This one here, it's not saying do the project or not. What it's saying is the story about the project, the different cash flows, and we want to know what is the net present value. Obviously, this is, Chapter 9 and 2504. If the present value is positive, then you go ahead and do the project. If the net present value is negative, then you don't. But how do you get to what that net present value is? This is kind of what Chapter 10 is about. Instead of just giving you the numbers, so the cash flow is this for that year, the cash flow is that for that year, give me the net present value, give me the internal rate of return. In Chapter 10, you're given a story about a company or a project, and you have to figure out what those cash flows are. So, identifying cash flows, or it could be a way of describing that. So let's look at what's going on here. And obviously, I got a board, not Excel, but in the real world, you'd be spending so much time in Excel, and this is how you would set up. This is still pretty simplistic on what you'll actually see in the real world when you go and get a real job, but it still gives you a pretty good idea of how you would go about how to do that in Excel, how to come up with a net present value, how to come up with a decision. So you look at the different years for the cash flows. So these are your different columns in your spreadsheet. You have a year 0, which is what happens at the beginning. So there's different things. If you look at the components of cash flow, you got the operating cash flow, you got the net capital spending, you got the change in net working capital, and so to give you your cash flow from assets. So let's start looking at parsing all this text and pulling out the numbers. A project will produce operating cash flows of 57,000 a year for 3 years. So these are your inflows. Now, the text is a little bit out of order. Next, they talk about the changes in net working capital. During the life of the project, inventory is going to go up, accounts receivable will go up, and accounts payable will go down. So those are the different things. So let's look at where does the change in net working capital come from? Remember that the changes in net working capital are Well, the net working capital is the difference between current assets and current liabilities. So when you look at the change in net working capital, you're going to look at what are the changes in current assets and what are the changes in current liabilities. In this case here, what's changing in current assets? Well, inventory is changing. If you look at the definition from chapter 3, if you review that, you'll see that another thing that goes in there is the change in cash, but it's not in that, it's not in the text, so I'm just not including it here. You got the inventory, you got the accounts receivable. So if accounts receivable go up, your current assets are going up. And then the last one is the only current liability that's mentioned there is the accounts payable. And it's minus that. It's going to get a little bit ugly because you're going to end up with double negatives and so on. But think of it this way. If your inventory goes up, that means you're going to have more net working capital. If your accounts receivable go up, that means you're going to have more net working capital. If your accounts payable go up, that means you're going to have less net working capital. So let's go through that. The inventory goes down by 10. The accounts receivable goes up by 20. And the accounts payable goes down by, or go down by 5,000. But it's minus a change of 5,000. In this course, always be careful with the signs. People make mistakes, students make mistakes with the signs all the time. So that gives you 15,000. So what's going to happen with the net working capital? This is a pattern that you got to understand. When you start the project, you're going to need to put that net working capital in. So that's going to be a cash outflow, right? You're going to take 15,000 in cash, and you're going to lower your inventory by 10, but your accounts receivable will go up by 20, and the accounts payable will decrease by 5. That means that 15,000 needs to come from somewhere. So that's an outflow at the beginning. And then when the project is over, you're getting that money back. That pattern you'll see, there's another one that you'll see in an example later on today, but that's typical of what the net working capital looks like. It's an inflow in year 0. It's an outflow in year 0, and then it's an inflow at the end of the project for the same equal amount. Next, the project requires the purchase of equipment at an initial cost of 90,000. So you'll have 90,000 as an outflow when the project starts, and then the equipment will be salvaged, creating a 17,000 after tax. That's a key point, key word in this sentence. After tax cash inflow. Remember, I talked about that last week. When you're depreciating something for CCA, and then you sell it for more or less than you're carrying on your books, then there's a tax effect. If say we're not talking about depreciation in there right now, but say you depreciated straight line your 90 to 0, but you get to sell that piece of equipment, say for 25,000. Well, you don't get to keep the whole 25,000 because you're going to pay tax on that. That's why it says 17,000 after tax. It's already including the, in that case it would be recapture. or it might have been terminal loss. It depends on. You can go to the video and the notes from last week. It depends when you go to salvage an asset, whether you get more or less of the same than what is carried on your books at for CCA purposes. So you receive in the last year 17,000. So your cash flows are minus 105 in year 0, 57 for year 1 and 2, and 89 for the last year. So now, I want the net present value of that project. So I sum up the cash flows for each year, and then this becomes my my series of cash flows that I take the net present value of. In Chapter 9, we just gave you what that is. In Chapter 10, you're given the story, and you have to figure out what the cash flows for each year are going to be. So the net present value, I'm going to use this. If you haven't seen it, so this is from time t is equal to 0 up to 3. The cash flow in that year. So what does that mean? It means the cash flow in year 0 plus the cash flow in year 1 discounted once. Underneath here, there's a 1 plus r to the 0th power. Any positive number to the 0th power is equal to 1. So it's like it's not there. Then you have 1 plus r to the 1st power, so we don't bother showing that. The discount rate is 12%, so we're dividing by 112. 112 squared. Like I said last class, you don't need to, for full marks in the written question, you don't need to give all the way to the cents. Well, I'm just writing it there. But so knowing how to set up the spreadsheet is key, because when we get into next week some of the little bit more complicated special cases, that's the base that we start with. You have one line for operating cash flow, one line for net capital spending, one line for changes in net working capital. That gives you your total cash flow from assets, and then you can just discount that. Now, there's more than one way to get to what operating cash flow is. Remember in the first lecture, I did an example of the first two. The first one, that's the basic. That's what you see most of the time. You should have seen it quite a few times already. The second time was the second one I did last week was that bottom-up approach. Remember that the first one, I started at what are my sales at the top, and then less my variable cost, my depreciation, I get EBIT, less my interest, I get my taxable income, less my taxes, I get the net income. Remember that we had the bottom-up approach where we were given the net income and we had to walk that income statement backwards. That's what the bottom-up approach to figure out the operating cash flow is you just take the bottom line, and in this case it works to get the expression directly like that. When there's no interest, what you do is you just take whatever the net income is, and you add back the stuff that's not a cash flow. But it only works when there's no interest. The last one is the top down, but you don't include the stuff that's non-cash. So the depreciation. So you just start at the top, minus less this, less that, but only the things which are cash flows. You don't have a less depreciation one. So you just sales minus the costs minus the taxes. Another way, and this one is going to come in quite handy in quite a few more complicated examples that we use later on, is you separate the analysis of everything versus just the depreciation by itself. So when you do the first half of that formula, you do the sales minus the costs. Remember that 1 minus t converts something from pre-tax to after-tax. So sales minus cost, that's my taxable income, and then 1 minus t, that's my net income, ignoring depreciation for a sec. And then what you do is you look at the depreciation tax yield, the amount of money, the amount of cash that you're going to have to pay less in tax because you have that depreciation tax yield. Simple example, if I have a CCA deduction, say for $1,000, and my tax rate is 30%, then what is that? The fact of having that deduction will reduce my tax payable by $300. So that creates an inflow by the amount that's called the depreciation tax yield, which is the depreciation times whatever the tax rate is. By having that deduction, it lowers your tax payable, therefore it increases cash flow. So that's an example of bottom-up approach. See, cash flow is so important that there's actually 4 different formulas, 4 different ways to get to that number. It's such a core, measure of a company. So in that case, the bottom up is simple. You just take the net income and you add back the non-cash stuff to get a cash flow amount. Now, in there, they don't actually give you the net income directly. What they say is sales of 1.9 million and it just says profit margin, but what they really mean is a net profit margin of 8.2%. Remember, you have your sales less your variable costs, you get to your gross profit or gross margin. Then you have all the other costs, all the other fixed costs, including the interest and the taxes, and you get to your net income. So the gross profit margin is that number divided by that number. The net profit margin is the bottom one. You get that question a lot on the either the Dragon's Den Canada or the Dragon's Den UK. What's your gross margin? What's your net margin? Just a little bit of recall from accounting. So in this example, we're not given what the net income is. We're just given what the sales are, 1.9, and we're given the profit margin. 8.2%. So that's how we get the net income. And then the depreciation is 238. That gives an operating cash flow of 393,800. This one here is the top down. All right, so this bottom one down here. And this shows up sometimes when, instead of being given, where does it say the quantity here? Oh no, I'm not actually using that. Okay, the sales are 450. The costs are 305. Increase the cash expense by 305. So it just gives that to you right away. Does it say the depreciation expense will be 36,000? So that's not. In the top-down approach, what it says here is don't subtract non-cash deduction. I realize that that's a triple negative, but that's essentially what I mean. When you start with your top-line sales and you take off the amounts, you just ignore the stuff that's non-cash. The example being, in most cases, the depreciation. And the taxes are going to be 38,000. So the key point here is that we didn't include the depreciation expense, and we also didn't include the 65,000 in net working capital because that's not included in the operating cash flow. The analysis of the net working capital is going to be included in the change in net working capital, and then it's going to be added up into cash flow from assets. But it doesn't actually show up in the operating cash flow amount. Now, this is this is the most powerful way of doing operating cash flow, because what you do is all that depreciation stuff complicates a lot of things, if you've seen. So what this tax shield approach does is it splits all the stuff that's not depreciation into one part and all the stuff that's depreciation into the other. It's very useful because when we do some of the problem types next week, this is the only way that we can get to what we're trying to, the number that we're trying to get to. Because if you don't split the depreciation, then what you would have to do is calculate the depreciation for each year. And so if you're trying to solve for a number in there somewhere, it's impossible. But when you split the complexity into those two parts, it makes, this is the only, out of the four approach, there's a couple of problem types that we're going to do. This is the only one where you can get anywhere with the questions by using this formula. So let's see how you. So the sales are 980,000. The non-cash costs are the cash costs are 535. And then you multiply by 1 minus the tax rate to get, so this is the pre-tax amount. Then when you multiply by 1 minus t, you get the after-tax amount. And then separately, you handle the reduction in tax payable from the fact that you have the depreciation expense. So what we're doing is the operating cash flow in the first year of the project. So the depreciation expense is going to be 1.2 million. The declining balance rate is 40%, but, and that's very important, we want the operating cash flow in the first year. So remember that half-year rule when it comes to CCA. We don't get the full 40% of 1.2 million as a CCA deduction in the first year. We only get half that. And then I'll multiply by the tax rate. So this is my UCC, right? Undepreciated capital cost in year 0. Right? This is going to be my CCA in year 1. And then the whole thing is going to be the CCA tax shield in year 1. Lots of students confuse the CCA deduction from the CCA tax shield. The CCA deduction is how much do you get to deduct. The CCA tax shield is how much did you save in tax from having that deduction. Lots of students have problems between those two concepts. That's why I'm making it a little more clear this time. So you get 373, 250. So, in 10.6, so this is the tax shield approach. Tax shield approach to calculating operating cash flow. So in 10.6, what they do is refer to your textbook, but I'm just going to talk about it in general terms. What they do is they have an example from Power Mulcher, which is, I think, a lawnmower company, in 10.4. So there's one way of doing the problem. Using the tax shield approach, there's a different way of doing the problem, and it simplifies it enough so that it's going to be, that technique's going to be useful next week, because that's the only technique we can use to solve some of the special types. Instead of using regular operating cash flow, you use this tax shield approach to calculating cash flow. You use the salvage value instead of undepreciated capital cost. Remember the so let's just look at, I'm building up the complexity, one at a time. I started with CCA, then I'm going to have CCA tax shield, and then the one more concept in complexity is the present value of the CCA tax shield. I just realized instead of doing declining balance first, I want to do straight line. I think it's going to illustrate the concept a lot better. Okay, the present value of the CCA tax shield if you have straight line depreciation. Here's the example. You lease a retail space on a 3-year term. You spend $30,000 in leasehold improvements. So what is the present value of the CCA tax shield given a 20% tax rate and a 5% discount rate? Remember that leasehold improvements, they're one of those straight line asset classes. There's very few. Remember, there's franchise was the other one I could think of. Couldn't think of any other ones. Most of them are declining balance. The reason why I'm using straight line is because it's a much more simple method to understand. So if I have $30,000 that I'm going to depreciate straight line over 3 years, that means my CCA deduction is going to be $10,000 each year. If my tax rate is 20%, that means that CCA deduction of $10,000 is going to save me $2,000 in tax. So $10,000 is the CCA deduction, $2,000 is the CCA tax shield. The present value of the CCA tax shield is the present value of that series of cash flows over the life of the project. So the present value of the CCA tax shield over the 3 years is going to be the present value of the tax shield in year 1 plus the tax shield in year 2 and tax shield in year 3. It's $2,000 every year, but the first year you discounted back 1 year, the second year you discounted back 2 years, and the third year you discounted back 3 years. So you get that by having $30,000 of leasehold improvements will save you, when you take the present value of that savings over the life of the project, in present value terms, $5,400. So I hope you understand the progression between CCA, CCA tax shield, and present value of the CCA tax shield. When you do declining balance, it gets a lot uglier. You could look at, say you could look at this one, and you could easily come up with a formula for that one, because what is that? That's just an annuity with 3 That's the present value formula for an annuity, just any kind of annuity. In this case, the payment is the $2,000, and the discount rate is the 5%, and the amount of time is 3. So that would just be 2,000, 1 minus 105 minus 3 over 0.05. Right? Understand that, because I put that, I put a written question with, I was trying to make things simpler for students in the written question, so I put in something with straight line instead of declining balance, and half the class didn't get it. So I want to make sure I clear it up a little bit more so you understand how straight line works. Now, most asset classes are just regular, declining balance. You have a percentage and you take off that percentage each year, except the first year you only do half. So in that case, what you could do is you could calculate, say, your full CCA schedule for each year. Right? You got your UCC, your CCA, you got whatever's left after you deduct your CCA. You roll. I got a weird way of doing it, but you can see that just the way that they handle the half-year rule is a little bit odd here. But they just take half of the amount and they deduct at the full CCA percentage instead of taking the full amount and deducting at half the CCA percentage in the first year. But anyway, so you got the UCC rolls forward, then minus that, then it rolls forward and so on. So you could calculate, say you're doing a project that's 5 years or 7 years or 10 years. You would have to calculate your entire declining balance schedule and then take the present value of that series of cash flows. Instead, that formula is very convenient because all you do is you plug in things that you know already. What's the amount that you started with? What's the declining balance rate that you're using for that asset class? What's the tax rate? What's your time value of money discount rate? How much are you going to sell the asset for at the end of the project? And how many periods do you have? If you didn't have the half-year rule, this part here wouldn't be there. All that this factor does is it just handles the half-year rule for you. So all you got to do, obviously you don't need to memorize that formula. You can write it on your formula sheet. Instead of going through the work of doing the whole depreciation, the whole CCA schedule, getting all the tax shield cash flows for each year, and then doing the net present value of the whole thing, it's just one formula, plug in the numbers, done. So let's show you an example. No, before I do that, let me show you how to figure out the CCA tax shield for just a single year. Not the present value for the whole thing, but just for a single year. So if you start with 642, so the rate is 30%, but remember, to account for the half-year rule in year one, there's two things you could do. You could either start with the full amount of the UCC, what you spend for the equipment, and multiply it by half the declining balance rate in the first year. Or the other thing you could do is just take half of this, so what that would be 321, and multiply it by 30. You'll still get to the same number, which is 96,300. So the UCC at the beginning of the year minus the deduction you took for that year gives you what your UCC for the next year is. Now you own that piece of equipment for the whole year, so you get the 30% for the whole year, not just 6 months. So this here, that's your CCA for year 3. That's not the CCA tax shield, that's just what the deduction is. So the CCA tax shield for year 3 is going to be the CCA for year 3 times the tax rate. So that's how you get the CCA tax shield for a single year. But what you need, the purpose of that present value of the CCA tax shield is to figure out, instead of doing that whole thing, and for each year figuring out what is the CCA deduction, multiplying by the tax rate, this is your CCA tax shield. And the CCA tax shield in year 2 and year 3 and so on. And then do the net present value of the whole thing. What you can do, which is a lot simpler, well, depends on your point of view, is to just use the formula and plug in the numbers. So present value of the CCA tax shield you're going to salvage in the third year, so SN is really S3. So the K is the discount rate. Well, let me just write it out. The I is the investment, so it's 22,000. The D is the declining balance rate of that CCA asset class. So in this case, it's 30%. Tax rate's 34. And then you have 1 plus 15 divided by 2. And then you have 0.3 plus 0.15. 115. So that's that 1 plus K here. The salvage is 6,000. Declining balance is still 30%. Tax rate is still 34%. So you plug in all those numbers, and you end up with 3767. One thing you have to be aware of, I don't think I brought a calculator with me, but when you do these kinds of things and you have a mix of plus, minus, and multiplication and division, you got to make sure that your calculator is in what's called AOS mode, as opposed to chain mode. And the way you do that is you go, does anybody have a calculator with them? What these calculators do, their kind of heritage comes from, probably you're too old to have seen those, but we used to have these big white flat calculator that had a little ribbon on them. And so you just punched in a number, and then it took whatever the previous number is, and it applied the operation on that. That was called chain mode. So there was no precedent. So if you if you did in chain mode, A plus B times C. Normally, what you want is A plus B times C. But what it would do is A plus B, take that answer and then multiply it by C. So you got to make sure that your calculator is set up in AOS mode so that the precedence works the way that you expect it. So in chain mode, it would do A plus B and then times C. But in AOS mode, which they call algebraic operating system, just with the regular precedence that you're used to from high school math, it will do the proper.
Without brackets?
Yeah, you don't have to punch in the brackets. The precedence will go properly. A lot of students have that Because they're like, I hate that calculator because the precedence doesn't work well, and I got to put brackets, and people bring another calculator because this one doesn't work the way that they expect. So what you do is you go second format, down, 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 down. See, yours is in chain. So what you do is second set, and it says AOS there. You restart the calculator, and then this is the calculator that you're used to from high school. And so when you do something like this, if you don't have it set properly, it's a real hassle. Because when you do the 1 plus thing, it's just going to screw up all the, you're punching in, I don't know, like maybe 15, 20 different, operations going through this. So it's really important that you set it up properly. So that's what I have to say about that. Okay, it's 8:05. So it's 8:05. Let's continue. So for the rest of the lecture today, I got 2 segments. The first one is to go over this comprehensive example in 10.6 of applying the depreciation tax shield method. And then at the end, I'll have more examples if time permits. So in the textbook, they have this big comprehensive example where they do it 2 different ways. They do it the classic way or the basic way, and then in 10.6 they show you how to do it in the depreciation tax shield way. So let's just look at the basic parameters of the story here. The unit price changes over time. So I guess that would make sense that when you introduce a product, you charge a little more for it, and then over time, you'll lower your price. The unit sales, what happens to them? They go up, then they peak in year 4, and then they go back down. And so to know what is the revenue each year, you just take whatever, P, big P, which is the price, and then a Q, which is the unit sales. That gives you the number of units you sell. So that gives you the revenue for each year. That's the example in 10.4 or 10.6, that's the same. If you were going to do the just regular approach where you go through the hassle of calculating the full CCA schedule, this is what it would look like. So you got 800,000 of equipment, but you only get the half year rule for the first year, and so on. So you got your CCA deductions for each year. It's a little bit tight. You can look it up on. You can look it up in the textbook, or you can remember that my slides are posted on lemma.ca and also CU Learn, so you can get that on your own device if it's a little bit too small to see. So for each year, you got the price times how many you sell. That gives you your revenue. So you have your variable costs, your fixed costs, whatever your CCA deduction is, gets you your EBIT. So this is the same as you've seen before. There's no interest in that case study. So you don't have EBIT less interest equals taxable income less taxes. You just get the EBIT and then you get your tax. So this is the income statement, the pro forma income statement. If you look at the cash flows for EBIT, the operating cash flow for each year, you take your EBIT, you add the CCA, and you subtract taxes to get the operating cash flow. Now, I had a question at the break, which is, does the net working capital, is it, it's negative in year 0, and then it's positive in the same amount at the end? That's a simple type of pattern that you usually see on quiz midterms and finals. A little bit more complicated setup, even though we don't give that to you in an exam, it'd be a little too long to do, But that's how most likely it would work in either in the real world or when we do the group assignments. By the way, you should start, forming your groups for the group assignments because we're trying to have that the assignment questions out. I'm hoping that the course supervisor is going to have that ready within a week or two. So you got to start getting your groups together for the group projects or the group homework or assignments, whatever you want to call it. Maximum 4 people. Could be as low as 1. If you want to do it alone, that's fine with me. But I suggest you do it with 2 people. 2 is the optimal. I've been working for long time. All kinds, big companies, small companies, big teams, small teams, and I find that the team of 2 works really well. With a third person, you always have a weak link. With 4, it's even worse. But with just 1, you don't have somebody else to interact with. So 2 is a very nice team size. So you can pick whatever team size you want, but start to get busy on figuring out your groups because the assignment's going to come out pretty soon. So in an assignment, a couple years ago, we had an assignment that looked like that. Instead of having you have a certain fixed amount of networking capital that you need throughout the entire project, and so that amount is an outflow in year 0 and then an equal inflow at the end. Another thing that can happen is it can be I need networking capital of a certain percentage of revenue. So, if I need networking capital to be 10% of revenue or something like that. I can't remember exactly how they what the story is in the textbook, but this is what's happening. So you start with networking capital of 20,000. Let's say they say 34. Oh, there's the table there. So it looks like they're doing a fixed percentage of revenue, starting with 20,000. So when you have 360, you need to have 54,000 in networking capital. So if you started with 20 to have 54 of networking capital, that means that you got to put in 34,000 more into the till. And then as your sales volume increases, you need to increase your net working capital. When the sales peak, after that, so when you're at 660, you only need 99,000. Well, actually, before that, when you're at 715, you need 107,250 in net working capital. But you already had, what would that be, 108. So at that point, the change in net working capital is negative. So that's a cash inflow. And as your revenue decreases, you need to keep less net working capital. Think of, the simple example is, if I'm selling things on credit, right, terms net 30, if I double my sales, my accounts receivable are going to double. I need to finance that from somewhere. So this is a more realistic pattern that you'll see either in a group assignment where you have the time to do this, or when you go and you get a real job and you're doing that kind of analysis. Usually in a quiz, a midterm, or a final, instead of this complicated setup, we just say, you need 20,000 of net working capital over the life of the project. So it's an outflow of 20 in year 0 and an inflow of year 20 at the end. But this is a more realistic pattern of net working capital. So you start with 20, then it goes up by 34, goes up by 36, goes up by 18. But you don't need as much anymore. So then you decrease each year. So when you look at, did I do the total? Oh, I see what they do on this one. What they do on this one is they show you how you would do it if you didn't use the depreciation tax shield method. Here's the key point. What you do is you sum up each year by column, and then you add up. I forgot net capital spending. You spend 800,000, and then you get back 150 at the end. So you get. Remember that it's minus changes in net working capital and it's minus net capital spending. So my cash flow, if I buy something for 800,000, that's 800,000, that's an outflow. Then at the end, when I sell used the piece of equipment that I don't need anymore, that's going to be an inflow. So I have my total cash flow for each year, and then you just discount the next line, that cumulative cash flow. You can just ignore it. That's just to figure out what the payback is. But the next one, discounted cash flow at 15%, you just take whatever the total cash flow for that year, you discount it back to year 0, then you add up these things and you get a net present value of 4,600. Internal rate of return of 15.15. Remember the discount I think is 15, so a small net present value means that the internal rate of return is only going to be slightly above what your required return, what your discount rate is. So this is the classic way of doing something. Now, if you do it using the tax shield method, what you do is instead of summing the cash flows for each year and then taking the net present value of the whole line, what you do is you sum things up by row first and then you add it up. So the basic method is you sum up the columns, you subtotal the columns, and then you total the columns together. The tax shield approach is you sum up the rows first, and then you subtotal the rows, and then you add those two together. That's the difference. Just think of a grid. Instead of going vertical and then horizontal, what you're doing is going horizontal and then vertical. You still have to sum up, add up everything that's in a two-dimensional table, but instead of doing the columns first and then summing up as a row, you do the opposite. It's useful because when we get into next week, some of the special cases, you need to do it that way, otherwise you just can't solve the problem. So what you do here is you look at the first line. So you take the net present value of 93 and 165 and 201 and so on. That's 645. The present value of the additions or changes in net working capital, that's just the present value of the second line. Normally, this is the one where you have a complicated net present changes in net working capital. But if you had a really simple setup like the one we did earlier, where you got operating cash flow, the basic pattern of net working capital, then the present value of that would just be minus 20,000 plus 20,000 at the end divided by whatever you're discounted for. So typically that's the pattern for net working capital when it's not too complicated. In this case, you just have the whole row. So you just do net present value with the cash flow for each year. That gets you minus 49,000. The capital spending, same thing. It's minus 800,000 plus 150,000 divided by 115. So that last one. So how did they get this number here? Present value of capital spending. That's going to be so that's where that number comes from. And the present value of the CCA tax shield, well, what you could do is just run the whole thing, calculate, the whole table, and you can see once you get to 8 years, it starts to get pretty ugly. It's simpler to just use that formula with the parameters that you know. You know that you're investing 800,000. You know what the CCA rate is and the tax rate and so on. So that's how you end up with the present value of the CCA tax shield. So what that says is over the life of that project for 8 years, you started with a piece of equipment that was 800,000. So you'll get CCA deductions each year. That will create a CCA tax shield. And all those savings put together, converted to present value, summed up, converted to present value today, that's going to be equal to 159,649. And so to get the net present value of the whole project, you just add up the net present value of each row of the table. So that's the difference between the basic approach and the depreciation tax shield. What you do is instead of having to calculate the CCA deduction and the CCA tax shield for every single year, you can just do it as one shot done and put in there. Because otherwise, think of, if you have 8 years and you have a problem like that, you got to put in the depreciation every single year. You got to calculate that whole thing. When we do something, there's some of the special cases that we're going to do next week, where instead we know the net present value, but we want to figure out what is the operating cash flow each year. It's impossible if you had to solve and put the depreciation in each year and sum it up by column, for each year, because you would end up with, an equation with 10 variables and 10. It'd just be impossible to solve. So that's the difference between doing the basic way and the tax shield way. Instead of summing up by columns and adding up the whole thing, you just sum up by rows first, and then you add up the total value of the rows. So this is the end of the new material for today. What I'm going to do, I explained to you what my more examples kind of teaching technique is. I'll just repeat it. Sorry if you were here last week. What I do with more examples is I never quite know, how I'm going to, finish for time. And the other reason is I've been teaching this course for many, many times. And each time I teach it, people say, we want more examples. And then I put more examples in my slide. People say, I get the teaching evaluation. The next time people say, oh, I want more examples. And so what I did is I come up with more examples at the end. I'm going to take a break now, just a quick 5 minutes. You can leave. Obviously, I won't be offended at all. If you don't see it now, you can watch it on video later. Or you can just, look up the slides and look up the notes for the answers. But it's definitely what I do is I come up with more examples of what I did today, just for the people that want to see a little bit more, but there's no new material. If you leave right now, you won't miss anything that you haven't seen during the class. All I'm doing is kind of a mini tutorial at the end as a slush fund of time. You know, if I end up, right at the limit, I just say, no time today. But if I finish early, right now I got 8:22. Then quick 5-minute break. You can leave or you can stay. It's up to you. So I'll start again in 5 minutes with more examples. Okay, so I got a couple more examples. So the first, relevant cash flows. So this is an example of a relevant cash flow type of question. So a retailer of men's clothes has average annual sales of 2.2 million. Thinking about getting into business suits for women. Is there something with your phone? It just flashed like a bunch of white lights at me. Sorry. It's like like, why is there paparazzis here? The owner is going to get into business clothes for business women. Should the firm expand into women's clothing, their current sales will decline by $400,000. But the store will sell $750,000 worth of women's clothes per year. That you might think that's a lot. But that's not ridiculous. Just to give you a simple data point, if you think how much rent is in shopping malls, Harry Rosen at the Rito Center, their rent is over $1 million a year for that place. And if you think of Sears, which just moved out, this is like multi-millions of dollars per year. So if your rent is $1 million, you got to sell 2, 3, 4 million to after you pay your cost of goods sold, you pay your employees and so on. I mean, these are actually pretty small numbers for retail. So if the sales are going to go down by 400, but you're going to get 750 more of sales in a different line, then what is the relevant cash flow that you would use, or the relevant annual sales, incremental sales, when analyzing this expansion? It would be 350. Because yes, you'll make 750 more in sales, in incremental sales from selling women clothes, but you're going to make 400 less in men's because of that. So your net incremental sales from introducing that new product line is going to be 350. So here's another example of net present value of a project. How many years have I got? 3 years. You always have a year 0. So you have operating cash flow. There's the operating cash flow. Well, let me just set up my whole capital spending. Changes in net working capital. So what cash flows are happening here? The operating cash flow is $68,300. So that's for each year. The net capital spending usually has the pattern of you have a very large outflow in year 0, you're buying some big piece of equipment, and you have a very small inflow, if at all, at the last year of the project, which is you're selling that piece of equipment used, right, which is called salvage. So in this case, the The cost of the equipment is $80,000, so that's an outflow. And work list at the end of the project, so there's no inflow at the end. There's no salvage. And then the networking capital, you need $6,000 in networking capital throughout. Like I said, this is more the usual setup that you get for a quiz, a midterm, or an exam. The one where you have the net working capital changing every year, typically that's what we just use for a group assignment because it's a little too complicated to put in just a quiz question. It takes a little bit too long. So in this case, you have minus 6,000 in the first year. In year 0, and then you get that 6,000 at the end. So what are the cash flows? You got minus 86 in startup costs. And for the first and second year, you'll make your 68,300. And then at the last year, what is it? So that's 74,300. So to get the net present value of this project, you just sum up so that's the reason why I use this summation notation is it actually makes it a lot shorter than having to write. Remember, you have less written problems to do in this section this term because we're not doing written questions on the quizzes. So you're only going to do written questions on the midterm and the final. But when you do written questions is you got to give the formula with the variables, the formula with the numbers plugged in, and then what the answer is. So this is just a much more compact way of writing it out. Instead of writing cash flow year 0 plus cash flow year 1 divided by 1 plus r, cash flow year 2, 1 plus r squared. This is a nice compact way of writing the formula, and it gives you full marks instead of writing because if I just went straight away, I just said net present value is minus 86,000 blah blah blah. You lose a third of your marks because you get, in general, the way that I do part marks, a third for giving the formula with the variables, a third for showing the formula with the numbers plugged in the right place, and a third for knowing how to use a calculator and punching it in. That's the return 14. So that's how you would do it using the classic way. I don't have it in my notes, but what I'm going to do now is just show you how you would have done this using the depreciation tax shield. I still have a calculator here. Can I borrow a calculator, please? Yeah. So I want to show you how you would do this question using, instead of summing up each column and then having the total cash flow and then taking the net present value of this, I want to show you how you would do this problem using the depreciation tax shield approach, where instead of summing up the cash flows for each year that way, what you do is you take the present value of each of the components. So the present value of $68,300 for 3 years. The discount rate is 14. So the net present value is 158. $567. Then obviously the net present value of the net capital spending is just going to be minus 80 because there's no salvage. But if there was a salvage, it would be minus 80 plus whatever's happening in year 3, discounted 3 years. The present value of the change in net working capital is going to be minus 6,000 today, and then 6,000 coming back 3 years from now. Sorry? Yeah, that's the OCF one is, sorry, I didn't write it out, I just did it on a calculator, but that would be 68,300 divided by 114. So as you can see, then the net present value of the whole project, instead of being the total cash flow of each year discounted back, the net present value is the present value of the operating cash flow plus the present value of the net capital spending plus the net present value plus the present value of the change in net working capital. And that's equal to you end up at the same thing. So that's the, I'm done with that now. Thanks. I just didn't have the 2 of the numbers. I just realized, for the football fans in here, I'm calling an audible. Sorry if that means nothing to you. But I just realized that it would be a nice example to show you how you do it both ways, but you still end up at the same place. And this method ends up being a lot more useful when we do some of the the questions next week, because one of them is we want to end up at a net present value of 0, and we want to figure out what is the operating cash flow for each year. So what we do is we figure out the present value of each one of those lines, and then that gives us the present value of the whole cash flow, and then we split the cash flow across the year. That's when we do bid price. You'll see that next week. But you can see that whether you sum things by column and then take the net present value of that series of cash flows, or you take the net present value of the present value of each line, and then you sum up those present value, you still end up at the same place. This second way, that's the point that I was trying to get to in the last segment today. I don't know how effective I was, but there you go. So let's do, this one's just a tax shield example for a single year. So I can erase this now. I'm actually going to write down the... Okay, so I can erase. So this next one's pretty simple. So what are my sales? 140,000. Now see, in that question, it's talking about net capital spending, 120,000 in fixed asset. It's talking about changes in net working capital, but those are not accounted for on that first operating cash flow line. Those cash flow effects are showing up in the net capital spending line on the spreadsheet and the changes in net working capital. So when you're doing that first line, the operating cash flow, this is just fluff you really don't need. It's just 120,000 and that 40, you just don't need to use that. So you got your revenue of 140,000. The cash expenses are 75,000. So that's your pre-tax profit, excluding depreciation. The tax rate is 34%. And then what is the depreciation? What is the operating cash flow in the first year? So again, you have the first year of the project. So you will have to account for the half-year rule. So 120,000 times 0.25 divided by 2. So that's your UCC. That's UCC. That's your CCA in year 1. And then if you multiply by the tax rate times T, that whole thing is the CCA tax shield for year 1. If it said in there, what is the operating cash flow for the second year or third year or whatever, you wouldn't have that divided by 2 there. Because your CCA deduction would be at the full declining balance rate, not half of it because of the half-year rule. Because right now we're in the first year of the project. So you just, sum all those up, 48,000. So last example for today, just a depreciation tax shield in the second year. First, I'm going to show you the, the kind of long, complicated way. Then I'm going to show you kind of a shortcut. I've taught this course so many times, I keep seeing these simpler ways to do things than in the textbook. So I'll show you a small trick here. I could do it the complicated, the full way, but you've already seen it a couple times, so I don't know if it's really worth it. But let me show you the more direct way of finding it. What I want is, what is the CCA tax shield in the second year? So what that's going to be is the CCA deduction in the second year times the tax rate. What is the CCA deduction in the second year? Well, it's going to be whatever the original cost is, and you're going to decrease that. Sorry, one more intermediate step is going to make it even more clear. It's going to be whatever the, I might as well just draw the whole table so it's clear. So you have the year, the UCC, and the CCA. In year 1, you start with 600,000. So if the sorry, I'm going to need to borrow somebody's calculator again. Okay, so let's go back to, let's look at this formula. The CCA tax shield in year 2 is the CCA deduction in year 2, which is this, times the tax rate. What is the CCA deduction in year 2? Well, it's going to be, so this here is your CCA 2. This here is your UCC 1. UCC 2. And so on. That's the CCA. Remember that the way that subscripting works. You have the variable, and then the subscript means what year it is. So undepreciated capital cost at the end of the first year is whatever you paid for it. CCA deduction in year 1 is 75,000. So the UCC in year 2 is whatever you started with minus that. What's another way of writing this? It's just the UCC in year 1 multiplied by 1 minus d over 2 times, so just think of this becomes this part. Because if you think of what is going to be in my CCA class in year 2, it's going to be what was in the CCA in year 1. What was the UCC in year 1? minus half of the declining balance. So 600,000 times 1 minus 0.25 divided by 2. That's going to be my 525 times the declining balance rate. That's going to give me my 131. But that gives me my CCA, not my CCA tax shield. I multiply by the tax rate. 34? No, 35. So that's a quick way. If you just look at that pattern, you start with what the thing cost, and then in the first year you'll reduce its value by 1 minus d over 2. You'll be left with what is my UCC. I multiplied by my CCA rate. So up to here gives me my UCC in year 2. Up to here gives me what my CCA deduction in year 2 is. And times the tax rate gives me what my tax shield is. Yeah.
Do you ever choose only the half year rule?
Yeah.
So another year you
Yeah.
see-
If you say if you were doing, so I'll just erase that now. Say if you were doing, this makes more sense once you get to a couple more years. Say if I was doing year 3, what would happen? Well, I have UCC year 3 up here. And that would be replaced by in the first year you take off half the declining balance, and then in the second year you take off the whole declining balance. And then you're still left with, if I was looking for what is the number that's here, so each year you just take that off by 1 minus d. This is a little bit more complicated, but once you understand this, this pattern, when you're doing multiple choice question, allows you to go a lot quicker through it. Because once you understand that to get a CCA tax shield, first you decline it by the half-year rule. Then if you have other years, you'll decline it by the full year. Then you get to what your amount is for that, what your UCC is for that year. You multiply by the declining balance rate. That gives you what your deduction is for that year. Then you multiply by the tax rate, and that gives you what the tax shield is for that year. So I wanted to go through the formula that way for you to start to get a little bit deeper understanding of what's going on here. All right, so that's it for today. I will see you next week. And remember, quiz 1 beginning in next class. And strongly recommend suggested exercises they're posted on CU Learn. If you don't have a way to get on CU Learn, this is something you're going to need to resolve to get through this course, because suggested exercises and the full worked out solution, we put a lot of work through that, and students really appreciate those when they prepare. So.